let's go ahead and get started. Hi, everyone. Thank you for joining today's webinar, The Impact of COVID-19 on Valuation. Today's program will be presented by Tom Reck, Partner and Market Leader of Witham's Forensic and Valuation Services Group. Before we begin, I have a few notes. Today's materials can be found in the toolbar on the right of your screen. Also, at the bottom of the toolbar, you will see a chat box. Feel free to send us your questions during the presentation. We'll do our best to address them at the end. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. Certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. With that, I will turn it over to Tom.
Thank you, Rachel. Hello, everybody. So, Tricia, if you could go to the first slide, please. Okay, so let's take a look back in March of 2020. So a little over a year ago, everything as we knew it changed dramatically. When you go back to March 9th of 2020, the Dow fell 2,000 points, approximately 2,000 points, which was an 8% decline. A few days later, on March 12th, after the World Health Organization declared COVID-19 a pandemic, the Dow dropped another 2,300 points. And then a few days after that, on March 16th, there was a further decline of almost 3,000 points to close at 20,189. Now, what's so astounding about this is just a few weeks earlier, on February 12th of 2020, the Dow had reached a record high of 29,551. And the loss was all caused by fears surrounding the impact of COVID-19. No one knew what it was. If you were to look back at headlines from March of 2020, you would see things like stocks struggle to rebound from worst day since 1987. Stocks struggle to rebound since the Black Monday crash of 1987. You'll see articles that addressed hospitals canceling on-site training for nursing and medical students. You'll see that articles discussing how hospitals were postponing elective procedures as the outbreak spread. And you'll even see headlines talking about the Nevada governor ordering non-essential businesses to close for 30 days. And when you consider how much of the economy is driven by non-essential workers in Nevada, that's an astounding statement. Locally, we had situations where in March, Governor Murphy in New Jersey imposed a 60-day suspension of elective surgery and invasive procedures. That was ultimately lifted in May 15th of 2020. And it should be noted that in March of 2020, there was only about 4,600 cases of COVID in the United States at that time, and there was approximately 85 deaths. So it was just amazing to see how bleak the picture was at that point in time. And as an aside, we've had many people now that are dealing with PPP forgiveness, and should they have gotten money, shouldn't they have gotten any money? And this is not intended to be a discussion about that. But you have to remember, at this point in time, and when I say this point in time, I'm talking March, April of 2020, and even some points after that, the outlook itself was very, very bleak, and people did not know what to expect next. Rachel, could you go to the next slide, please?
Yep, so we're on to our first polling question. A mega merger involves 2 companies with revenue over blank.
So the first is 10 million in revenue, annual revenue, 100 million in annual revenue, 500 million in annual revenue, or over 1 billion in annual revenue.
All right, about 15 more seconds. All right, I'm going to close it out. And here are the results. So it's about
The
25%.
answer is, yeah, and the answer is over 1 billion in annual revenue. Interesting. Okay. Okay. So what happened next? We had the recession, or the impending recession, and the response. As we were just discussing, as a result of so many closures throughout the United States, unemployment rose dramatically, and as of April of 2020, it hit almost 15%. Industries such as hospitality, theater, childcare sectors were severely hit. On March 27th, then President Trump signed the Coronavirus Aid, Relief, and Economic Securities Act, the CARES Act, in an effort to help folks through this rather difficult time. So as a result, stimulus checks were paid to adults, unemployment insurance was enhanced and extended to individuals, while, as we discussed, businesses were able to avail themselves of the PPP program. Next slide. Hospitals received help. The CARES Act allocated $100 billion to hospitals to reimburse them for expenses associated with COVID-19. So that was huge. The last I read, that was actually up to $180 billion, which was earmarked for healthcare specific funding. So not just hospitals, but all in was somewhere about $180 billion. There was the increase in Medicare payments of 20% for COVID-19 patients. Certain regulations affecting telemedicine were waived so that it could be expanded. Unfortunately, HHS was criticized by some who claimed that certain hospitals who had higher COVID patient rates were not being compensated the way they should be. They were being shortchanged, if you will. And then currently, the American Hospital Association is seeking to have $35 billion of the $1.9 trillion COVID-19 relief package allocated to hospitals. So that the efforts to quell the results of COVID continue. Next slide. Okay, physician practices. Non-essential visits were canceled. I mean, that's just across the board. You know, there were certain folks, so for example, if you had someone that was on dialysis, many of those folks continued to go, but you know, by and large, anything that could be canceled was. Many of our clients were either closed or were working minimally for a number of months. Some entities like ambulatory surgery centers were closed, as we discussed, for a period of time before being re-allowed to open. And elective procedures declined significantly as a result. The employment that went along with that was significantly decreased as well. So you may have had certain, you know, physicians who were taking patients on a skeleton crew, but by and large, you know, business did not continue as normal. One thing that did increase was telemedicine. So telemedicine, although there was fewer employees ultimately being employed through the telemedicine, it did make its way into the mainstream. Where there was a deficiency, however, was with elderly patients who did not experience that same sort of ability. They didn't have iPads, they didn't have iPhones in many instances, so that was a negative impact. And generally through 2020, healthcare workforce was down in comparison to the pre-COVID levels. Next slide. So smaller practices. So what we saw was many smaller practices had revenue that was down rather significantly. 32% was what many practices were down by. That's huge. And that's not necessarily, that 32% is across the board. Certain areas of the country were hit much harder than others. The Northeast, for example, was hit pretty hard as a result of COVID-19. That same report indicated that nearly 20% of physicians had a 50% decrease in revenue between July and August of 2020. And that was especially, as we said, especially true of physicians who serviced older patients. And also, and I'm sure you're all aware of this, there was great difficulty in obtaining PPE, and smaller practitioners were competing against larger institutions just to get the goods that they needed in order to be able to practice. So as a result, private practitioners began to seek alternatives, such as joining larger groups. Unfortunately, many practices, especially if you had physicians who were older, who began to question whether it was worth staying in practice. Were they going to be able to meet the needs of the practice in terms of its funding? Was there going to be out-of-pocket expenses that they were going to have to pay? What about paying rent for their location? There was a myriad of things that the smaller practices had to deal with. And as a result, many throughout the United States did not survive. Some did, but many did not. Next slide.
And we're on to our second polling question. As a result of the COVID pandemic, fill in the blank.
Yeah, so we have physicians saw their volume increase between 320 and 620. Patient volume of primary care physicians increased. The use of telemedicine increased, and unemployment declined. Those are the choices.
About 10 more seconds. All right, and here are the results.
There it is. 88% the use of telemedicine increased, correct. Okay, hardest hit areas of specialty. Ophthalmology, 29%. Otolaryngology, I can never say this. Okay, ear, nose, and throat, 28% decline. Gastroenterology, 25% decline. Dermatology, 24, and pathology, 23. So what you're seeing here is virtually any practice requiring in-person visits, especially those providing elective procedures, were hard hit by COVID-19. Specialties that were not nearly as severely impacted were nephrology, as we discussed, and radiation oncology and hematology oncology. So those were areas that were not nearly hit as hard. So what's the significance of that? Well, I think many times what happens is when there's a valuation to be done, folks tend to think generally in terms of it's a medical practice, right? Or something similar to a statement like that. The problem is, in this particular case, as a result of COVID-19, there's great variances between the effect that COVID had based on the services that were being provided. So that's very, very important to note. If you are being asked to value an ENT practice versus a primary care physician, there could be significant differences in what the valuation conclusion would be. So that's just a very important point to make, to be specific as to what it is being valued. Next slide, please. So selling prices were affected by the downturn. So that's absolutely true. Physician practices were negatively impacted by the downturn. And patient volume is a key factor here, right? So once the patient volume was down, that had a negative impact on the income and the cash flow. And you probably, maybe some of you are thinking, well, it's the difference between income and cash flow. Well, the income would not necessarily include any debt that had to be paid, whereas the cash flow would. So the cash flow could even be less than what the income would be. So that's something that definitely needs to be given consideration to. So if you are thinking of selling your practice, one of the things you're going to have to look at is, what is the debt associated with the practice? What am I going to have to pay down upon sale? And what is the net amount that I'm going to realize as a result of that transaction? Now, some owners did not have a choice. They had to sell at lower prices, given the uncertainty surrounding COVID-19. There was just simply no way that the practice could survive. Some were able to, as I said, take advantage of PPP loans, but many, even despite that, were not able to make it, and they did not survive the downturn. And as we said, this was especially true for physicians approaching retirement age. In addition, as a result of the pandemic, hospitals did not necessarily have the ability or the desire to buy practices at that point. So the result was, for a period of time there, a reduced pool of potential buyers. So if you have negative impact at the entity level, that's one thing. But when you have a negative impact at the industry level, that just compounds an already bad situation and makes it that much worse. So that was something that was occurring here in early to mid 2020. Next slide. Okay, so who are the potential buyers? So you had physician practices where one of the main attractions is not having to deal with administrative functions, right? So that detracts from having to do all that, detracts from having the ability to provide the medical services that you want to provide. So that's a nice thing about the physician practices if you merge into something like that. The other would be hospitals. The issue with hospitals is there's often very little paid for the practice itself. But the good thing is there's usually an attractive compensation that's tied with the RVUs. So basically, the harder you work, the more you're able to make, and there may be some, as we said, incentive payments or bonus type payments included in there. So that would be a second option. And a third would be private equity, where typically the upfront payment is attractive, but the ongoing compensation is less than what you're used to earning, or what the physicians would be used to earning. So that's something that would need to be given consideration to. I mean, another option would be not to sell at all, and try and grow your way out of, return to some sense of normalcy, as opposed to selling your practice and moving in with someone else. And there's a lot of considerations that need to be given here. So if you decide as an individual that you need to invest in particular equipment, that's on you to buy that equipment and figure out funding. If you're part of a larger organization, that capital expenditure comes out of a much larger budget as opposed to what you would be dealing with potentially. So there's a consideration that needs to be given there. Reimbursement rates may be different. So if you were to join with a larger practice, certain procedures that you're providing for which you're collecting X would be X plus something if it was with a larger organization. So that's a consideration. And then there's the whole issue of if you have, the electronic, or not if you have, most do at this stage, the electronic medical records, you have someone that's walking around with you whom you are paying to write down everything that's being done and keep the records accurately. As an individual, that's on you to pay that. As part of a larger organization, that is going to come out of the larger organization, or maybe a separate management company. So, those are basically the options. The other thing is, as we said, if you're looking to retire at a certain point in time and you're part of a larger organization, hopefully there's some sort of agreement in place that talks about, what your practice is worth upon retirement, as opposed to having to look for a buyer at a certain age later in life. So there's a lot of things to consider. There's a certain amount of autonomy that's lost when you decide to sell your practice to a larger organization. And there's a lot of things to think about, such as, again, how you're going to be paid, if there's going to be ongoing um, any ongoing obligation on your part to fund the larger practice itself. So those are the sorts of things that one needs to think about. And with that, we'll move on to the next slide. Okay, so valuation metrics. So valuation multiples can be tricky. So it's not uncommon for the basis of valuation to be a multiple of EBITDA or a capitalization of earnings. So EBITDA is a term that we use. It's earnings before interest, taxes, depreciation, and amortization. It is it's a term that you'll often see referenced in the valuation community. So you'll hear someone say, oh, my business is a 5-time EBITDA, or my business is a 7-time EBITDA. Essentially, what you're looking to do is capture the cash that's going to be coming out of the business. So that's why you're not including non-cash items such as depreciation and amortization. You're not looking to capture the interest on debt that might not exist at the entity level when it's sold. So that's a very common multiple that you will see. The source of metrics is either from private transactions or from publicly traded companies. So what will typically happen is, once the EBITDA is determined, we will look at different sources of data to determine what the EBITDA multiples are. There would be other multiples that we would look at as well, but what the EBITDA multiples might be. Sometimes you may find something not an EBITDA multiple, but a gross profit multiple or a percentage of gross profit. It depends on the industry. But those metrics are tracked in various databases for both private sales, so entities that are privately owned, or publicly traded companies where those metrics are tracked. So the issue was, and still is, what metrics to use given the COVID pandemic. And we know that in early, March, April of last year, that those multiples declined rather significantly. And unfortunately, as we discussed, some of those transactions occurred out of necessity for the seller, and the price suffered as a result. So you'd almost get into a situation where the transaction price really wasn't fair market value. And what do I mean by that? Fair market value talks about willing buyer, willing seller, both knowledgeable of the relevant facts and not being done under duress. So if you have a business or had a business in March or April of last year that you basically had to sell or face, severe consequences as a result, that was the best you were going to get, and it was done out of fear and necessity as opposed to a desire to really want to sell the business. So that's something to keep in mind. Multiples faced a short dip, but because valuation is forward-looking, many have bounced back. So that's absolutely true. And if you are looking to sell your business today, one of the things I think you would want to say, if at all possible, is, let's disregard what happened in 2020. 2020 was a bad year. It's an anomaly. And for the following reasons, I think my practice is going to be doing X moving forward. I think it's going to be picking up again. And as a result, the value is going to be based on what the future expectations are versus what it was in a prior period of time. Next slide.
All right, we're on to our third polling question. Because of the COVID pandemic, traffic congestion increased, public transportation usage increased, restaurant bookings increased, and ASCs were unable to provide service uninterrupted. All right, about 10 more seconds. All right, and here are the results.
That would be the answer I would have chosen, right? 84%. Okay. Next. Okay. Volume is key. So coming out of the pandemic, practices began to see their volumes increase. Unfortunately, for many, it was a rather slow process. So, if you were to go into a hospital waiting room or you were to go into a physician's practice, every other chair had tape across it, you couldn't sit at it, etc. So the volume of patients that practices were normally able to see was reduced. I remember going to an eye doctor not that long ago, and I was getting a call in my car to let me know when it was safe to come in. That sort of thing, just slowing down the process of onboarding patients and having them serviced by the physician, by the practice. So one thing that's interesting though is there was a pent-up demand in certain areas as a result of closures or as a result of the inability to see patients on a regular basis. So there were some entities, and I know of one in particular ASC that I'm familiar with some folks there, that's been operating longer hours during the day subsequently and was operating on Saturdays as if it was any other day of the week. So the volume was down for quite an extended period of time, but afterward, that volume was made up. So as you surely can see, volume is the key. Once the practice is back to pre-pandemic levels, one may wish to consider at that point, what do I want to do now? Do I want to sell or do I want to remain in practice on my own? That ultimately becomes the question. And it is best, to defer the consideration of that issue until such a time as the volume and the profitability have increased and hopefully return to a more normal level. That's incredibly important. Now, if you're in a situation like that, meaning that there was a period of time that things were down, but there was a subsequent catch up, it may make sense if you are looking to either sell your practice or if you happen to be potentially looking to acquire a practice, it may make sense to look at the practice on a monthly basis for a period of time. And the reason for that is because the production being down generally led to cash collections being down a month or two later. So if you had cash collections that were, through April of 2020 were what would be considered normal, but from May through the June or July timeframe, collections were off rather significantly as a result of not being able to provide service in that March-April timeframe, that's relevant. because you don't want someone valuing your business on an annual basis, let's say, ending December 31st of 2020, if that is not indicative of what the practice is able to do moving forward. I mean, there's just, there's no two ways around that. What you will find, or what you may find, is once certain time frame hit, and in many instances it was probably July or August, that you really began to see the numbers spike. So I was actually just brought into a matter where an individual didn't work in March and April of last year. The numbers looked to be way down, but when you looked at the subsequent months and you looked at what happened in July and August, you could see that the volume increased significantly, as did the cash collections, as did the profitability, et cetera. So it's important to not necessarily look at a calendar year. You'll hear the expression, I'm sure, TTM, trailing 12 months. That may be the best time frame to look at if you are going to look at historical earnings. That is something you're absolutely going to want to consider. And in addition, if historical results are not expected to be indicative of future income, they shouldn't be used in the valuation process at all. So if 2020 was an anomaly, you don't want that being used for purposes of valuation of your practice. So forget looking at the last 3 to 5 years. You're going to have to look at something else. And generally, that would be a forward-looking valuation that would be done, a discounted cash flow, it's called. So that would be something that would be given consideration to. If questions to ask and considerations to have from a valuation perspective also becomes not just in terms of the income statement, but what about the balance sheet? So, for example, what does the balance sheet look like at the valuation date? If you look at that at the valuation date, is there a large cash balance at the valuation date? And if there is there PPP money sitting in that cash balance? Now, if you're the buyer, you may not care, what the seller has in terms of cash. You're probably going to say you keep your cash, you keep your receivables, but it's certainly a consideration in terms of the overall value of the entity. And it raises another question then. If there is PPP money sitting on the balance sheet, are there any contingent liabilities associated with that cash sitting on the books? So, for example, is that PPP loan going to be forgiven? If not, has there been any sort of liability booked? What are the ramifications of having that liability to the buyer and to the seller potentially? Another thing to look at, especially as a result of COVID-19, is receivables. What effect has COVID-19 had on the collectability of receivables? Do any of the receivables need to be written down? Are the receivables on there that you're now going to have to send to collections, and you're going to be incurring additional legal costs trying to collect the receivables? So that's another consideration as a seller that you need to think about. What ultimately am I going to collect at the end of the day? Another thing we've seen from time to time is inventory that needs to be reviewed in further detail. We have seen instances where there's some obsolescence for inventory that's on the books. Some practices may have tried to load up on goods early on in the pandemic, only to be stuck with certain inventory that they were unable to use. It's not too broad a problem, but we've seen it. So that's something to be given consideration. And when you look at the profitability of the practice and sticking with inventory, if you look at the income statement, was there a lot of purchases in 2020 as a percentage of gross revenue that you didn't have in prior years that you need to give consideration to. So there may be an adjustment that needs to be taken for that. So you're going to have to look at expenses across the board. So areas that could be off, for lack of a better way of putting it, obviously is the revenue that we've discussed. What happened in the first few months of 2020, what's happened subsequently, was there a pent-up demand, was revenue caught up on or was it not? What impact does that have on the practice or the business looking forward? And then you're going to have to look at other things such as, purchases as a percentage of gross revenue, salaries that are being paid. One thing we've seen is, certain folks decided that they didn't want to work anymore when they could collect unemployment. Physician practices came back, doors reopened, and certain employees either were not offered their jobs back or they did not want to come back. So there could be costs associated with salaries that you were not expecting to face. And of course, once there's salaries involved, then there's payroll taxes associated with that. So that's something that has to be addressed. Next slide. Industry outlook. As we talked about, physician pressures will cause physicians to join a practice group or hospital. I mean, it's happening. Some entities, as we discussed, some entities that closed will not reopen, and there will be gaps in coverage in certain areas. People may have to drive an extra half hour, 20 minutes, 40 minutes, whatever it might be, to get that X-ray or whatever it is they might need. Revenue is not expected to reach pre-pandemic levels for some time. Now, I will tell you that, if you read, and I'm sure you all do, but if you read the industry information, that's a common statement. That being said, some practices have been very fortunate and have really returned to what I would say is either almost normal or normal in many instances. And what's also interesting is when you look at industry outlooks, and there are a number of them, they all talk about an annualized rate of growth of about 3%, which is typically what inflation is. So if nothing else, you'll be keeping level with inflation over the long haul. So that's at least a good thing to know. In addition, due to the pandemic, the expected shortage of primary care physicians is expected to occur even faster than originally predicted. If I recall correctly, that the largest shortage is to come in the year, I think it's 2030, if I recall correctly, and they're talking about that even being moved up as a result of COVID-19. Next slide. Normalized earnings. We talked a little bit about that, but let's talk about it in a little bit more detail. Just as an aside, if you've been involved in a valuation process, you'll hear the term normalization adjustments or normalized earnings. And sometimes I don't know that it ever really gets defined. It's just kind of accepted. But the purpose of normalization adjustments or normalization is to provide the best estimate of future ongoing income. That's what's important. So if you've had, a practice that is generating, X dollars in terms of procedures and cash collections of, I don't know, say 40% of whatever's billed, 20 to 40% of whatever's billed. And then from there, you're paying all your expenses and you expect to have a profit of, make up a number, 30% of your collections, just as a hypothetical. That's what the value needs to be based on. So it's important to capture that. Now, what we'll often find is, especially with smaller physicians, where there's a group of 4 or 5 doctors, there may be expenses that are being paid through the practice that if you were a member of a larger organization would not be. So what do I mean by that? There may be officer compensation that really has no bearing to the overall productivity of the individual physicians, for example. It could be there's a $300,000 profit, everybody's taking their salary, there's still a $300,000 profit after that, I should say. We need to divvy it up. There's 5 doctors, each are taking an additional $60,000. There's no longer a profit. You know, the objective is to zero out the tax burden. So that officer compensation may or may not have any bearing to RVUs, WRVUs, etc. Other personal expenses that we would typically see. Automobile expenses is common. And if you're a physician that's, you know, going from place to place, that's one thing. If it's really driving from and to the office, that's another. Rent paid to related parties, if the rent is not fair market value, that's something where an adjustment could be made. Certain insurances, whether it's a personal disability policy, for example, or home, auto, whatever the case might be, you know, that has really nothing to do with the practice itself, and that would be an adjustment. So the objective, if you're a seller, really is to get the normalized earnings, you know, as high as possible, for lack of a better way of putting it, so that a greater value is derived when that income is capitalized. And when you think about it, that concept is very foreign to many folks because, you know, if you have someone that's been in practice for 10, 15, 20 years, their objective has always been to minimize the taxes and get rid of any income. Now you're in a situation where you're trying to boost the income for purposes of trying to get a higher value associated with that particular practice. So that's something that folks sometimes don't even, they have difficulty relating to. And it can be an eye-opening experience for individuals to realize what their true earnings historically have been. We've had that situation. So, you know, that's something that needs to be done. That whole normalization process needs to be done to strip out any non-recurring items and non-business expenses. Those all have to be stripped out. Now, we talked a little bit about you know, future expectations, right? So one of the things becomes this idea of a discounted cash flow. What does that mean? So let's just say your practice is entered into, or a practice has entered into a new contract, and as a result of that, or it took on a new doctor, or something has changed, so that when you look at the historical results, they bear little resemblance to what the future expectations are expected to be. If that's the situation, then you'd be in a situation where you'd want to do what's known as a discounted cash flow. So you're going to want to take a look at the future revenue for, let's say, 3 years out, what the expenses are associated with, or the collections obviously first associated with that to get it to more of a cash basis, the expenses associated with it, and then any future capital investments and debt obligations that would affect the cash flow. All of those would need to be considered for purposes of determining a value. And it's not uncommon for us to be provided with 3 or 5 years worth of projected income statements. And typically what we'll do is we will look back at prior projections, budgets, things of that nature to see just how realistic the projections might be. And we'll do evaluation on that. Now, again, talking about it from the perspective of a seller looking to increase value, you know, there could be a situation where something negative has happened, and maybe you are sitting on a, you know, you're sitting on a business that the future is not rosy for whatever reason. Let's just say you're an ASC and the competitors opened up, you know, 6 blocks away, whatever it is. And as a result, some of the physicians that are working out of your ASC are now going to be working out of the one 6 blocks away. What's the effect of that on expected future revenue? So it's not always an upward curve, but the point being, you need to know realistically what the expectations are going to be moving forward. So that's something that needs to be addressed. And if you are looking to sell a practice, I think it's important to have some of these calculations run. You don't necessarily have to have a full valuation report done. So let me just lay that, let me lay that out there. Any of the valuation firms, and I'm sure, any of the attorneys that you deal with know who those firms are. They can do calculations of value, and those calculations of value are not as detailed, if you will, as a full or valuation report, but they'll give you an idea as to what the value would be. So if you could just go to the next slide. Oh, okay. I got ahead of myself. So yeah, sellers need to understand the basic worth of their practice. And you may not need a valuation report. A calculation report should give you an idea as to what the value is without going through a full valuation process, without having a whole industry section, a whole economic analysis, all of that. Just the range of the value of the practices between X and Y. That can be quite helpful if you're looking to sell your practice. Expectations as to it allows the seller to have reasonable expectations as to the value, given that there are certain unknowns to account for. So as we discussed, future revenue levels, expense levels, capital investments, debt obligations, things of that nature. That's a real benefit to having calculations done. Next slide.
On to
Only
our
question 4.
final. Stark law changes include
Stark law changes include exceptions for value-based arrangements, additional guidance on exceptions to the self-referral law, additional guidance for non-abusive beneficial arrangements, and the last, all of the above. And there were some Stark law changes in the not so distant past, some of which were temporary.
All right, I'm going to go ahead and close it out. And here are the results.
96%, wonderful, cool, good. Okay. All right. So, so next, the M&A market. In the early part of 2020, I think this is common knowledge, but M&A deals slowed. Some were put on hold for a period of time as everybody began to grasp with the new reality that existed. By the summer of 2020, activity picked up again, and it continues storming along actually in 2021. Urgent care systems are seeing activity as entities are looking to add areas of specialty in order to provide one-stop shopping, right? I mean, it's how many people want to go to a place once as opposed to 2 or 3 different locations. So to the extent that there's strategic alliances that can be performed or that can ensue, those are happening. And as the number of vaccinations increase, there's this propensity to believe, and I hope everyone's right, there'll be this return to normalcy. Now, what's interesting is I took a look at some publicly traded data. And what's interesting is when you look at the enterprise value divided by the EBITDA, you'll see pretty large swings. So the median EV divided by EBITDA for February of 2020 was a 13.6 time multiple. For February 28th of 2021, that median multiple was 18.65. So that's a good, 5% increase there from 13.6 to 18.6. Now, what's also interesting is in March of last year, the EV, enterprise value, divided by EBITDA multiple was 10.4. And when you look at March of 2021, that's up to 18.65%. So that's up, 8.25% in a year. And then you look at April 30th of 2020 versus 2021, you'd gone from a 14 to a 17. So you can see that the low last year around this time, or around March of last year, was a 10-time EBITDA multiple. And now you're looking at somewhere between, and I'm looking at the mean, by the way, you're looking at a mean multiple of somewhere between 17 and almost 19 times. So what does that mean? It essentially, it means that the expectation is that the future is a hell of a lot more rosy now than it was a year ago, which is a wonderful thing in many respects. What's also interesting too is, there were some SPAC acquisitions in the not too distant past either. So you had specific entities being formed for the purpose of buying practices or entities that provide medical services. So it's an incredible thing the way the market not only reacted to the pandemic a year or so ago, but it's also maybe even more incredible just how the market has turned around and it sees the overall outlook as being much more positive. So that's that. And again, if you are looking to sell a practice, always be looking out for, what does the future hold? Just as the market comps that we're talking about here are much more rosy, hopefully your individual practice is at a point where its productivity has increased, its profitability is bouncing back. If there's debt associated with it, hopefully the debt obligations with it are being able to be paid, and you move forward. But this has been a very, very interesting time, and it's been very interesting to see what's transpired with the multiples as they relate to COVID-19. So with that, I am finished. I didn't forget anything, did I? Nope. Rachel, did we lose you? Rachel, are you there? Okay. All right. I think we've had a technical issue here. Yep. We've had a technical issue here. I apologize, everybody. So with that, I don't see any questions. So with that, we will wrap up the day. Thank you very much. Thank you for joining, everybody.